Have we just lived through a week of peak crazy? Is this possibly the most important Fed speech of the year? Kind of yes and no to that question. Jerome Powell today, the Fed chair, speaking as interest rates have been held. So there's been no increase or decrease in the Fed interest rate. The speech is important because, in so many ways, it balances out the last week of peak craziness as silver prices have been setting all time highs, what feels like every day. And you've got gold setting all time highs literally every day. It just keeps on rolling with gold currently at $5,385. We go into this Fed speech with questions in our mind about, is there a debasement of the US dollar world collapse panic happening right now? Or are the comments from Scott Bessent on Tuesday of last week at Davos actually not to be taken with a grain of salt, but to be set in stone and really taken to heart, because Jerome Powell is here with the kind of steady back of the tug of war with the rope tied around him, like Sir Duncan the Tall was in the latest episode of the Night of the Seven Kingdoms. You've got him standing there, kind of steadying the ship and lending a lot of credence, actually, to what the other guys in government have been up to. And despite the fact that these two, Jerome and President Trump, are having a bit of a kind of standoff with each other, we're in a situation where Jerome Powell is ending up being Trump's greatest ally. This Fed speech could settle a lot of nerves about the way the economy's been performing, but it could also open up questions for the dissenters who are going to say, you know, you're cutting too slow, too little, too late, Jerome Powell. And there's a subtler viewpoint here, which I think is really does exist, where what you have is him filling in the gaps. There was a lot of peaks in the economic language, the landscape of it recently, sharp ones, and the lot of gaps in between these peaks as to what the information really is going on in the economy. And what Jerome does here is he levels up that kind of base layer of understanding and smooths off a lot of those economic peaks. We did predict a lot of what's coming up in today's show, by the way. So if you're just watching here for the first time, you're new, you should be subscribed, and you'd understand what was happening last week during the hysteria. I mean, and things have changed since last week. If you just cast your mind back, you'll remember you were just about to get out your old army uniform, like in the opening scene of the Three Musketeers, digging it out from under the ground to go and defend your nation in Greenland, as you like those that we looked like we were about to go to war with Greenland. Well, crazy. And then that last week we were saying, well, what's actually happening here is going to lead into this week, and we predicted the events that have happened today, including actually this really quite calm delivery. And we're going to dive into this, and we're also going to be taking a look at technical analysis on silver, which is, I think, peak interest right now. Here's the micro silver futures chart. We can do a bit of that. Do stay tuned then to the end of the show for the technical analysis section. We'll be discussing some peak interest topics. Right now, we've got Bitcoin at $89,232. Actually, just before diving into the speech, I suppose we should just check in on the regular markets to see how they've consumed it so far. SPX now closed here at a price of let's just call it 7,000 more or less. You know, it's really not looking so bad. Just below the 50 simple moving average on the 15-minute time frame. But if we put this in a bit of context, actually scrolling back, we can see that this week we've had yet another one of those all-time highs, and today is the same. Red day, right? Okay, red day, but overall, this is not markets panicking about the hold on the interest rate. So it's good to get kind of that early feedback from markets. Here we can see that there is a rise in NASDAQ as well, coming back up to challenge its all-time highs, so not doing badly there. But, of course, this is peak shorting area, right in this zone, near these prior highs, and there is a danger lurking in the economy. So one of the other reasons why there's such a big, important speech is this, which is the Dixie chart. This shows the dollar value against a basket of currencies, okay, just so you can understand basically what we're looking at here. And you can see that back in January, the dollar was at 110 bucks compared to this basket of other currencies, and now we're down at 96 bucks. That's a big drop in the space of the last year. When you consider, if we jump up to the weekly time frame, you can see that's been a bad year for the dollar value. Now, politically and things like that, there's different reasons, fiscal policy and so on. Our man Jerome may touch on some of these subjects during his speech in the Q&A session, so we can wait to see what his comments are, I suppose, on those aspects. But this is not really the job of the Fed to influence this, albeit rates dropping would cause a decrease in the value of the currency from a typical economic, macroeconomic view on how these things work, because you've got various levers you can pull to influence an economy. If interest rates fall, then there's less demand to buy the currency to keep it in a bank account to get some yield off of it, that type of idea. And as they drop, there's less demand for it. But this has got more to do, I think, really, these drops with the macro kind of sentiment and the conditions and the fiscal plans of the economy. So there's something at odds here, and we'll have to see how your man talks about it. Here he is.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. Having lowered our policy rate by 75 basis points over the course of our previous 3 meetings, we see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace.
This is the speech portion of the overall kind of speech and Q&A section. Speech is quite short, ladies and gents watching along. The Q&A section, where the back and forth among the audience participants and Jerome Powell, lasts quite a bit longer, and it's where the meat and bones of this really do exist. What we have here just coming is a little bit of information about how the economy is performing. What we've heard so far is that the numbers, the data that the Fed are looking at, are giving them the optionality that they need, and then showing that their position is relatively okay, that they can react as needed. But it's not that kind of jump forward like, hey, yeah, we've cut the rates. But of course, we knew that it was a hold. So this is what we expected from the speech. The optionality thing is a key part of this. And if you remember the show from, as we were talking about employment rates and the SAM trigger, which secretly, silently triggered and has not been officially recognized by the government, how what was actually going on there was giving them optionality. And we can see that now in full effect. In fact, if you do recall that stream that I posted, and if not, then maybe after this I'll put a link in the video to it, but you should go check it out on my channel. I discussed the SAM rule, and there were some really interesting implications from the optionality that it gave the Fed, and the fruition of that is now visible. So let's hear what the numbers come in at, and it's quite interesting.
Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low.
And that was that optionality in effect right there. He knows as he's saying it, and you might be able to see it in his face even as he's saying it, that if the government shutdown hadn't actually happened, then the figures would have been published and it would have had a SAM rule trigger event occur. And if you don't know what that is, it's actually one of the most famous economic triggers in existence because it says, wow, there's a big recession coming in. It's either already started or it's about to happen, but its level of consistently predicting these events is so high that it makes literally every single economic analyst in the world, from the president of America to the sort of shoe cleaner in Nairobi, actually, well, I mean that maybe not as much to the shoe cleaner in Nairobi, but it makes most people pay attention. And the thing is, he's just after saying that they've stabilized, and that's not really interesting. We're stabilized. We've heard it in earnings calls from companies recently. It doesn't mean that it is actually, stopped moving around at all, and it doesn't actually even mean that it's the same number necessarily from one report to the next. It just means that the rate of change has not gone up so much. And the question with employment is about trajectory. So when you understand these figures, it isn't so much to say whether there's 1, 2, 3, 4, 5, 6, 7% unemployment, and if it hits, say, 10%, that is the trigger for some action. What we're looking at is instead the rate of change. Because if you're seeing month over month more and more and more people becoming unemployed and it's expanding, then that's a massive signal to the government or to the Fed that it needs to act. Whereas if that figure is not expanding out, it's not getting worse at all, it's just a stable figure, then even if it continues to be an overall worse unemployment rate, then that stability is about the trajectory, and the trajectory is all that matters. So actually what we're seeing here is quite an interesting dynamic, because had the inflation figures been really low, they sure could have made a cut based on that alone, just that the inflation figures are so low and employment is relatively at risk, so why not? However, the inflation figures that we're about to hear are still kind of got mud in the water.
Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal.
Right. One of the things that you'll notice is he's using PCE, which is their preferred metric for inflation figures. You got different ones, CPI, PCE, and so on. Now he's talking here about how they remain elevated, and that a lot of that is to do with tariffs. This is stuff that we've talked about on the show for quite a while, and we will be looking throughout the year to see how this actually plays out, because if you cast your mind back to this time last year, Donald Trump was just elected president, and he came in and started announcing a lot of tariffs. Those were scheduled to come into play at certain dates with different figures that changed over time, and a lot of uncertainty grew in that period. But there were tariffs imposed, and it did happen at some point. Now, then the companies themselves absorbed a lot of that cost differential and slowly passed it on to the consumer, which means that the effect on the price change that you were paying wasn't necessarily on the day that the tariff was announced or even the day that it was imposed. It was some time after, and the full extent of that wasn't necessarily right up front. It might have happened by now, where you're paying as much more as you're going to pay on certain things because of the tariffs. It could be that there's still some room left that companies are going to pass that through, which Jerome will talk about here during his Q&A section as well. But it was now a year ago that this sort of stuff started kicking off. And inflation figures are year over year. So if you say inflation is up because of a tariff, which is not going to keep going up, it's just a one-off, then when you compare the next year after that to the year the tariff was put on, there won't be that tariff increase on inflation any longer. It'll just be the inflation as if, everything was the same. Which means as we look throughout the year, we should see that impact start to drop off. But at the minute, there's a differential between the core inflation numbers, which are closer to 2%, and the actual numbers that we're getting in the data, which is around 3%. So there's that differential still in play, and it's not clear exactly how much remains to be passed on to the consumer.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. Since last September, we have lowered our policy rate 75 basis points, or 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%, once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis.
And this is him coming to the end of the speech. You might be thinking, that's a lot of that needs greater color. And that's what the Q&A session is for. You would then also possibly be lulled into thinking that last sentence that he said there wasn't important. Maybe already forgotten it. What was it? He was saying that they're still going to be making their decisions on a kind of case-by-case basis, and that there is no set trajectory. One of the signals that the Fed can give to people is that there is a set trajectory. They did this back when interest rates were rising. They rose sharply at first, but not to the full extent they were going to rise. And the Fed did come out and say, we're on a trajectory of upward interest rates. And that then happened over quite a long time. This time around, we've had a few cuts. It has been a few consecutive ones. He's making that point, and this time there's a hold. The question comes from people, is there a glide path that we're on? Which would be a good thing to be on. Everybody would find that quite inspiring. However, it's too early for them to say that because they want to keep this optionality aspect that they have. So instead, he did make the point that there is no set trajectory. That means that in the next decision that we hear, there'll be more of this chat about how we're making decisions based on information as it comes in, and less about how we have seen that there was no detrimental effect to the cuts that we've already had, so we're going to continue on the set path that we set out for ourselves. This is a distinction, and it is an important one. It matters an awful lot because it's to do with like projections looking forward. So if you were thinking what our interest rate's going to be in a year and you wanted to take a bet on it, if he'd said we're on a set downward schedule, you would know that that was a pretty good bet that you would be short those interest rate figures and you'd make money. Without having that said, it doesn't give you that good bet, which doesn't increase that kind of self-fulfilling prophecy aspect of it. So it is actually quite important and it impacts sentiment going forwards. But the way that he said it was not in a very negative way, to the point that it was almost forgettable, and I needed to point it out.
To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
And a lot of people have questions. The dual mandate thing is important. Maximum employment. They want all the jobs that are available out there to be taken. It's got less to do with we have a population of 100%. We want our employment figure to be 100%. It's less to do with what direction is the employment figure going in. It was 4, now it's 4.3, that sort of chat. It's less to do with that and more to do with how many jobs are being created each month and how many people are turning up and saying, I'll take that job. And if we can maximize that, then we're doing as good as we can with what's available, with what we have to work with. If that is happening and still there is a decline in workforce while inflation isn't going up, that gives you an impetus to the Fed to cut interest rates because you want more people to get into employment. That's part of the mandate if you kind of do go for that maximalist view on the mandate of get everybody a job, which ultimately would be the case. But the way that they conduct it and have done for a century is along the lines I'm just explaining there. Now, the Q&A section, some of these questions are great and some of the questions are not that great. And there are some interesting ones that are kind of surprising. And a part of the whole Trump ally here happening is exposed a little bit in questions that I'd actually know the political leanings of these people, but you kind of get an impression sometimes from somebody who's asking a question if it's kind of meant to have some, if they're going to go back and write a particular type of article based around the questions they're asking. And then you think, well, how he handles this is going to have implications. And he can either do it in a way that goes Team America, or he does it in a way that's, undermines something or whatever. And what's going to happen. And you'll see, I think, anyway, that actually he leans on being supportive and a teamwork way. We'll see, though. You can make your own mind up. And by the way, as we talk about this, there is a poll running in the chat right now. When do you think interest rates will drop? Spring, summer, autumn, or the winter of discontent? Get your vote in there and you'll see so far winter of discontent is the winner. So people are not expecting interest rates to be cut anytime soon. Interesting.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to ask that you attended the Supreme Court hearing last week on the Lisa Cook case.
This one is skippable, to be honest with you, because he's asking about whether or not you've done something. There's precedent for people to do this.
And Treasury Secretary Scott Bennett would say,
do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 100 hard to
and whatever.
The job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest.
This is a question which is worth asking, but he's asking it quite specifically to do with a specific aspect of the last speech. What he's really kind of saying in terms of the category, the genre of the question is, in your speeches, you say things, and then the next speech comes along. You don't always necessarily follow through with what you said before, but quite often you do. In some instances, it's notable, such as this one to do with employment figures, because there was a government shutdown. Maybe the numbers are coming back and they're being authenticated, confirmed, they're not. What was your read on it? It was notable that you didn't bring it up, and that's why I'm asking. That's what he's trying to say here, and the answer to it is simply that the data has indeed changed. It was worth saying last time. It's not worth saying this time, but we do notice that that you'll say something and then it's kind of for the moment and less to do with really necessarily how they think and feel and are going to act. For example, if you cast your mind back to September, there was a Fed meeting and a chat then about looking at forward-looking indicators for their data and having to kind of bring some more of that into the workings that they use, because a lot of the other data was becoming less certain or perhaps affected by things like government shutdowns and so on. And in advance of a very predictable government shutdown, just kind of like we are in a way now, he said that they would use some forward-looking figures. And then a couple of months go by, and later on in this Q&A, you'll notice somebody asked a question about that, and he kind of just acts as if he's never really talked about that before. Fine, that's fine. It's actually quite fine, because what he's doing here is bringing stability and and calmness is really what he's trying to deliver, and that works by leaning on tradition, right? But you do notice that from time to time. I don't really think that these questions are particularly useful from this guy.
Just that we're still in a negative stabilized.
The distortions in the data from the shutdown, however big they were in November, they're smaller in December. So we're getting to a place where they're no longer material.
So we didn't mention them.
Was simply so we saw data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling, and so we thought that was no longer an accurate description of the data.
So I skipped quite a lot of his answer there. Right, next question.
Nick Timros, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure.
This is a good example of how he doesn't get involved in political stuff. If you wanted to watch a great example of somebody in a tight spot when the light's being shined on them, having a consistent, calm personality and not being kind of dragged into talking about something, which this is one of them, of which there are many, and most kind of good political figures are quite proficient at performing them. It's really just like a little bit of jousting, doesn't really matter. Moving on.
On that today.
Mike.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve?
Another part of the chat that we've had on our show and stuff recently, traditionally, when someone is the chair and they're no longer the chair, they just get out of the whole group altogether. It's just tradition. So people kind of are wondering, whenever this guy's had such a combative relationship with Donald Trump recently, would he stay on in his job because he has the right to, and then he would be a part of the group and able to influence and cast his vote as well, or would he take a back seat or even go away entirely, as is tradition? And it's not any secret, that hidden secret, like the what's coming up next, and there's going to be a different style of Fed chair nominated and so on. So there's this kind of question. Is whether, it is worth discussing, but kind of like here between us, it's a horrendous waste of time in terms of the Fed meeting when you have the opportunity to ask them a question of real, you don't do it here and then. But anyway, it happens, and you'll notice that initially, these initial kind of bits and bobs, where you would expect traditionally would be front-loaded with the pertinent questions, have had a smattering of noise, right? It's fair enough, we've skipped through it, but it's been there. Later on, you would anticipate maybe perhaps a bit more of that noise coming in as people take a chance towards the end of the session, but it kind of reverses a little bit, and you get stronger questions towards the end. And that was what I was noticing a little bit about these commentators. I don't know what their political leanings are. I don't know what motivates them, but it's interesting, and the best answers come from there.
And if so,
anyway, skip this.
That either.
Dances.
Again, there's a time and place. Thank you.
Thank you. Claire Jones, Financial Times.
She's out there representing the UK. She's got a regional accent. You might not pick up on it if you're from the United States. She is the editor of this, and that she's respected lass. Does she ask a useful question that gets answered? Unfortunately not, but it is relevant to the chat we've had today, so it's worth putting up and listening to it, because it is such a big deal that it's being brought up here, and you might as well hear Jerome's answer, because it's the sort of thing that I explain a lot on the show, but why not hear it from the horse's mouth instead?
Thanks a lot for taking my questions. In another one that might,
Stop laughing.
lead to a similar answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the US currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
But I mean, what's your view on the market movements? I mean, what do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't, we don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
And that was actually quite useful for Scott Bessent to, be acknowledged that his department exists and that it has important jobs and everything else. As you remember, here is the dollar chart, and as you can see, yeah, it's enough to be brought up in the discussions. 99, basically 100 just yesterday, and then today you've got it down at 95. It's a big drop. If you think about how a tariff can get imposed on a country, well, everybody who was, spending money abroad in any way is now hit the next day on their holidays. They go down to the bar and they discover that their pint costs 5% more, or the skiing trip or higher or whatever. So this is a real thing that comes up in the mind of people to the extent that it can be mentioned in a Fed Q&A. But obviously they don't influence that. However, they would had they been putting up interest rates, putting down interest rates. It does have an impact on the demand for the currency, and it can have an impact on exchange rates, and it can be something that they can think about. Of course, they monitor them, would be the way that he would talk about it. But what you could have said there as well in answer to Claire Jones was like, well, as you know, we held interest rates today, so the value of the dollar dropping isn't cause of us. What he was doing by giving a kind of a boring, perhaps standoffish, not engaging answer was actually showing respect to the pillars of government and outlining boundaries, and all of that creates stability and respect and actually certainty. So really his kind of dismissal of the answer and the fact it was brought up and he was talking about it in a calm way, it shows that they've got no intention to act regardless of the dollar value, that they're doing the right thing for their dual mandate, and it builds up confidence in the small things. It's like, get back to basics. And that was a question. It was kind of an inadvertent setup. I found had an all right outcome for it, despite the fact it was essentially irrelevant in many ways. So it's worth putting on the screen.
Hi, Chair Powell. Neil Irwin with Axios. Obviously no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market in the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
This was an opportunity for him to say back in December we were quite clear about what was probably going to happen coming up in January and what we were waiting for and so on. And actually what people might have thought back in December is kind of politically loaded. I don't know if people thought back in December that there was going to be more rate cuts than they're scheduled to be. I think back in December you had the biggest banks like JP and so on talking that there'd be 2 rate cuts maybe at most. Maybe if you look back to November there might have been better expectations, especially compared to the point being that seemed, I don't know what's motivating that question, but it's kind of worth asking, albeit we know the answer already. The why it's worth it for us, because we have the extra insight of having seen this thing about the SAM rule trigger, and it's kind of a question about employment and how does he handle it, knowing what we know, yet what nobody else is discussing, and what most of the people in that room don't know. But between us and Jerome, there's some insight here.
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the beige book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
Yeah, well, it wasn't really his question, and he understood what we understood as it was being asked, like, why is that phrased in that way? And he gave that answer as a result. We'll get a little bit more clarity.
But in terms of timing or pacing of any additional easing?
So we haven't made, what we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data, the implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings.
So this is just to reiterate, we explained this at the start, and he did say it during his speech, and it was something that was almost unnoticeable just before he said in conclusion, and we stopped to mention specifically that is actually quite important. Here in the Q&A, it's getting expounded upon, and we can hear a far wordier way of saying the exact same thing. Like, actually, it's a real point that he's making, that they're making decisions meeting to meeting. And I mean, I hate to kind of labor over something that maybe perhaps that my very well-educated audience fully understands, but I think for the new viewer, it's worth doubling down on that message.
But, the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
And this has got an awful lot to do with inflation expectation, because one of the core secret silent drivers is inflation expectation. Actually, in fact, in this Q&A, does mention inflation expectation charts of this Federal Bank St. Louis. Is that actually the one to look at? Yeah, this is going to show us here, and we have various questions during this. We'll touch upon this topic, and the backbone of understanding what words are being chosen is to do with this metric of inflation expectation. Because if he said that the cuts were coming in, then there would be a greater inflation expectation, and inflation expectation is one of the biggest drivers of inflation itself, which sounds like a kind of meta, second layer nonsense, almost spiritual made up thing. But actually, it's very true. It's because people plan their finances looking forward. If you think the car that you're going to buy is going to cost $10,000 more in 3 quarters, you'll take out a $3,000 loan today to buy it, rather than having to save up $10,000 over the next 3 months. And you think, right, I'll buy it today. So that is a real thing, and it drives inflation. He then says that it's come down a lot. If we look back to certain periods in time, and I think the big point here of note was in 2025, July. If we look and see here, towards the end of July, the figure on inflation expectation actually crested 2.4. It came to 2.41. And you have to go all the way back to the 2024 October sort of time to find it at near those levels, but it didn't actually get as high, so it'd beaten that one. You go back then to July 2024, the previous year, and then you've got the higher numbers. So we can see there's a cyclical kind of component towards inflation, that looking throughout this year, inflation expectation is probably, if we consider the last 2 years, going to peak around about July. So his need here at the start of the year to manage inflation expectations going forwards so that they've got the best run into July is very important, given that this is actually one of the biggest drivers of inflation itself. Crazy 4D chess? Is that what we're seeing here happening live? It actually is, even though it's so subtle and just comes across as a chat between 2 old men in suits. If you want to look at it in terms of more detail, kind of the sharp end of the stick, then you have July over here at the peak, and you saw that figures came down. Into November, things were looking like they could have been a bit better with inflation than people felt throughout December, which is why that question from that guy was weird. If he'd asked said how people thought in November, sure, but not in December, because inflation expectations were on the rise in December, and there was a Fed meeting in December, and they spoke about it, and it's a weird question. So if you just said then, but then they came up to a peak here in January, kind of a bit kind of nuts recently, the stuff that's been happening, but actually they then shrank right back down again. And that is something that comes up. So it's interesting to show that as a chart.
Steve Leisman, CNBC, and sticking with questions you might answer. Thank you. You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the SEP and the longer run rates, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. I mean, maybe I missed by one, but I thought it was 4. And if you look at the dealer survey,
Maybe he's including himself in that 4.
it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy's significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. You know, it's in the eye of the beholder, and of course no one knows with any precision.
And for the kind of the non-cynical, erudite, tapped-in viewer here, the exchange between these two is the most interesting exchange throughout the entire chat by head and shoulders, quite a margin, obviously. And what he's talking about here, of course, is to do with like the group of them that vote in on this. We already knew that the trajectory had been said so far to be kind of decision by decision, and that was quite clear. It's been hammered down on that while they might feel like they have an expectation within themselves personally that they're willing to express on a survey about how they view interest rates should proceed, it doesn't mean that they're not making that decision on a case-by-case basis. So you might be the president admittance person for some musically talented school, and you might feel that every single child should get into that school and be treated to a wonderful musical education. But you're still going to admit people on a case-by-case basis. I mean, you can have a function and a belief system which are not properly aligned. And but this is to do with what they think they're going to be doing, right? It's an actual survey about what they think they're going to be looking at going forwards, and how there's that their rate currently is within what would be considered to be neutral if you had quite a broad look at what that neutral thing was, or else, you know, neutral or towards the looser end, or it's somewhat restrictive. And he's not hiding away from the fact that that's the way that it is, and he keeps then referring back to the optionality. And this is the positive-faced, helpful, the alliance to Besant and the alliance to Trump way of presenting this data, as opposed to saying what he could have easily said, which would then create fear and increase the inflation expectations at the same time, and be damaging probably as well to the dollar value. But that's whatever. The would be to say, well, we've been given so much uncertainty, and we were just told the other day that there would be 100% increase on tariffs to our biggest trading partners. So, and that is delayed and not necessarily coming in. It really is a tense political situation that's got sensitive negotiations that are happening, and he really can't be dragged into discussing that. So, but if he was able to say any of this, it would be massively preclude any trajectory advice that any of the group in the, could give. So you've got a really interesting discussion where both of these people know both of these things, and they're not talking about it, which is like the kind of conversation you see in the dinner table scene at June, or in the book June, or if you're reading Game of Thrones or whatever. You know, it's an interesting conversation where both of them know that the actual topic is the subtext, but I just wanted to bring you in on it as the viewer, so we can see it play out some more.
Is that, you had a follow-up?
And that's how those things often end. You know, he's looking over to the guy and saying, have I satisfied your quotient of this thing? And then we can see that he pats the ball back over in their game of paddle here.
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah.
And you see, and that's why the conversation keeps circling back around to that almost throwaway line that he made at the start, and why that's really important. And I think that's settling into everybody watching now at this point, that is indeed something that's worth having labored that point a little bit for, because that's what these guys are discussing here, and that Game of Thrones, not talking about it, but talking about it sort of a way.
Yeah, no, I would say if you look at the SEP from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
For all the girls in the audience, let's use a Hunger Games reference. And for all the boys in the audience, let's use a PUBG reference, where you're having this kind of battle royale with a bunch of other perhaps impoverished teenagers or really well-equipped random mercenary soldiers. And there's a massive dome around you. And every so often, that shrinks down, forcing the battleground tighter and tighter together. And that's the path towards normalization. Everything inside the dome is normalized. Everything outside of that is some sort of, it's evaporated. And there's a plan to move towards it. Now, a really kind of like gung-ho person would say, let's go to the very center of that dome, where, of course, you're going to encounter the most other combatants and where all the action's happening. And then the more prudent Hunger Games combatant, I don't know if it's Peter or whatever, or the PUBG player if you're a boy, they're kind of coming in and thinking, I'm going to look at the edge of this dome. I'm not going to be in the danger zone. I'm going to be on the edge of it. I'm going to look in. I'm going to see how everybody else is fighting, and then I'm going to run in when I've got the data. Both of these people are staying within the rules of the game. Now, on this team, you've got somebody who's saying, which is the sort of the fat guy there, is saying, we need to get in there now and start, offloading on these people because we need to gain momentum and get ahead of this. And on the other side, the other team member, Jerome here, is saying, no, we need to go in here and just take a second. We agreed in principle this is where we would move to, and we've done that. We have achieved the normalization we looked for while we're at the edge of it. Now we need to look in. And this is kind of where a bit of a debate about too late or not too late can come in. But as we already explained, just last week you were looking at an invasion of Greenland, but with American soldiers and military. Apparently Trump was willing to do that. And if not 100% rises tariffs on the biggest trading partners and stuff. And it's like, well, we're not allowed to discuss that. So if we're not allowed to discuss that, we're going to discuss it in these means. Well, at least so you can understand what it means to be moving towards normalization. And it's like there's different types of trend. There's are we going to stay ahead of the tide, moving towards normalization before we go in that danger zone and get wiped out? Or are we going to run up and really try and build some sort of momentum? But if your target is normal and target is normalization, like not high interest rates, but also not low interest rates, you're not incentivizing the economy and flooding money into it. Are you being too restrictive and disincentivizing the economy? You're trying to stay in that neutral area. And neutral obviously moves around where it is based on the context, because a low interest rate could be neutral under certain contexts, and a high interest rate could be neutral under certain contexts. And there was a fairly momentum-driven ride into this area. So that's the kind of the language combat that's going on between these two. I hope that provides some insight.
Amira. Thank you, Chair Powell. Mara Mokway from Bloomberg News. To what extent did the committee discuss the possibility of cutting at this meeting or in March? And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
Spoiler alert, he doesn't want to answer this, woman. For whatever reasons. I think because of the first question was set up wrong, just being like, did you even discuss it? And that's kind of like, I'm going to have to answer that, which is annoying, before I get to the actual question, which is kind of giving too much away. But we do hear from him later on about what conditions would make it a change. It just took somebody else to ask the same sort of question.
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters.
As you can see, he didn't bother answering the question, just got to the point, this broad one. And of course, the other main point being that nobody's expecting to actually rise the interest rates. There was much discussion about it bidirectionally, of course.
So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting.
That was important for him to do because it's a language trap. These things are all back and forth. Even if the other participant doesn't realize that they entered a jousting match and asked the question, a normal one, like what conditions would it take for you to cut them? That's a decent normal question, right? Then from his point of view, it's like, well, if I actually answer that question, I'm setting the standard. I'm going to be held to that. And I can't do that if I put a test down in some other condition, because you'd have to name 50 variables, right? But you can't do that in normal conversation, and it's just pointless, right? So he has to answer like this, and he has to do that to fend off, speculation.
What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook and all that. And we see that it's a bit risky, and we'll find our
effects of tariffs already moved through the economy on prices.
A lot of it has. So basically,
yeah. So this guy is asking, have the effects of tariffs moved through the economy already?
Basically, there are many different estimates, and they're all highly uncertain. But most of the overrun in goods prices is from tariffs, and that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So,
who needs allies when you've got enemies like these, right? What is Trump really complaining about? Unless he's personally concerned about his own interest that he's paying on his own debts or something like that. It doesn't, so like, what's the need to cut type of chat? What's it motivated and driven by, and so on? Well, there's a lot motivating that. But then is Jerome Powell actually combatively stanced against it and disparaging or negative? No. And then is this effect of tariffs being seen as being something that can move through the economy? Absolutely. He's not saying it can't even do that, or it's going to have knock-on and build-up effects or cause some negative cycle. He's not even talking about that. But what is the subtext here, of course, is, for goodness sake, don't do any more. Right? That's so clear, because every time, and this is the thing, like, if you need the message to be heard by the opposition here to you, which is that every time you put a tariff on, I'm not going to cut interest rates for 9 months, right? Which is basically the subtext that he's delivering in this Q&A section. You'll notice that by the end. Then don't put any tariffs on, right? If you want interest rates to be cut, don't be putting any tariffs on anybody for another year, because every time you do that, I'm not going to cut for 6, 7, 8, 9 months. And you'll hear that. That's why I said 6, 7, 8, 9, so you could listen out for that later on.
Most of the overshoot, if you were to take that out, inflation, core PCE inflation is running just a bit above 2%, x the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, if we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge, or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
And there's your answer to the previous question the woman had asked before, but put such bad context around it, he couldn't bring himself to actually answer her. He does it here instead. There's two aspects to things, and so I think that's quite clear, actually, in terms of the answer, that he does think that tariffs will move through the economy, that they'll stop impacting on inflation figures and won't be impacting, therefore, on their decision. In fact, it's quite good because there will be some positive impact on their decision if they see inflation drop an awful lot. And that is on the cards. And then the missing sentence, so long as you don't put any tariffs on now, right? That's the missing sentence. And I think that's the way that somebody who's maybe not doing the stuff all on the same mandate as you, but is working strategically in some sort of supportive role, would present something that, you know, does cause real difficulty to the economy, to the president, you know, not in a really combative opposition way, but in one which is where you've got different mandates where you're both working towards the good of the American people. And I think that that's important to not say it, so long as it can be picked up by somebody. I mean, I'm putting it out there. Hopefully that influences the world in some ripple way that it makes it to the top.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything for you on that. That will depend on Congress's actions and things I can't speculate on.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the Band-Aid as roughly balanced right now? And is the next move necessarily down?
And this is moving into a phase of the conversation where people want to try and figure out whether or not the Fed is looking more at employment or more at inflation. As we said, there's a secret silent, nobody's allowed to talk about it, Sam trigger ruling that indicates the economy is definitely ruined. But it's avoidable by doing this. Now, are they more concerned by employment or inflation? It's an interesting question. It's trying to ask one of these heuristic questions to get a deeper insight into what they're talking about. I think you won't win any prizes for guessing what Jerome comes up with here, but I don't disbelieve the answer.
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And we think our policy's in a good place. I've just discussed reasons why we might change our policy, and we'll just have to see how the data lead us.
I'm wondering, you a minute ago you said you felt expectations were consistent with your mandate. That the 2 and the 10-year break-evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked at all of the both survey and market-based short-term inflation expectations have come way down.
And this is why I have this up on the screen, by the way, folks. So let's just let him continue to explain it. You have seen the chart already. Here's come way down. And let's see how Jerome describes it.
They were in a good place at the beginning of last year. They spiked around Liberation Day, and now they've fully retraced.
So he did a little hand gesture, good place, spiked, fell, and then you've got good place down here. That's pretty good too. Spiked up to 2.41, came way down towards 2.15 sort of. And if this trend continues, maybe we see a lower low in here. And if inflation expectations were to drop, the expectation of inflation were to drop below 2, that in itself, without even needing to be a super genius financial economist, would really indicate that inflation itself might drop below 2 as well. Is it like the ask the audience question on Who Wants to Be a Millionaire? Maybe. But also, it's, as I said before, if people are expecting inflation to be very low, then equally that car they thought about buying is not going to go up by 10 grand in a few months, so they'll not buy it today. They can afford to save up to do it more financially prudently and sensibly, not take any risks themselves that they don't need to take, and things go smoother. And generally speaking, the world goes smoother when everybody thinks the world's going to go smoother. There actually is a real science to that. Anyway, it was worth bringing that up because he did talk about the 10-year as well. And as you can see, there's a lot of mess on this chart over the period of 10 years that inflation expectation in the long haul can't necessarily be said to necessarily tell you stuff. You got down here, you've got like in March 2020 time, that inflation expectation dropped off the edge of the cliff. Well, we all thought the world was going to end, right? I mean, you might have kind of recovered so much from that period that you don't remember that, but that's what the world was saying. And then obviously they spiked way up when people realized the world wasn't going to end. Oh my God, what were we thinking? Why did I spend so much money on pajamas? Oh my goodness, what's this Peloton machine doing in my house? Where did you come from? But yeah, so inflation expectations, 10-year charts, not like, I think broad trends are available to be seen there, but
in the last few months. So that's very comforting. And the longer term inflation expectations have remained in places that are very consistent with 2% inflation over time. So expectations have been solid, and they reflect confidence in the return to 2% inflation.
Andrew.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
The reason you cut rates in the past, this is one of these questions that, like, this guy is coming, I don't know who this guy is either, right? It's so funny how much people have got all day to think about the question they're going to ask and the words they're going to use. And they probably thought the perfect question, but when it comes down to asking it at the time, they can't help but just put in some semantics that color it that aren't necessary. Because the truth is that were the decisions you made in the past based on real things, does that remain true? The question he just asked was about the past decisions. Well, obviously the past decisions, the truth they told at the time in the past remains the truth today. It's a bit of a stupid question, but what he's actually trying to ask is, would cutting interest rates impact inflation, have a risk on impacting inflation towards the upside, which has to be balanced against any potential gains on the job market. That is the basic basis of when he's been talking about the dual mandate the entire time. So you got to wonder where the attitude comes in with the question. It's an interesting one. Sorry to sound repetitive. I guess he just needs more clarity. In fact, one of the more interesting ones comes from this lady just behind, who I think has a similar sort of attitude thing, but it's more interesting. So we've got that coming up to look forward to.
We haven't made, you're right, we saw the labor market weakening and we acted. And I think that was the appropriate thing to do. We will always act to address what we see as the economy moving away from our goals. Risks to both of the variables are a little less. I think the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that I'm not making a judgment about how, one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
If anybody asks Jerome Powell about policy uncertainty, he's going to naturally assume they're talking about Fed policy uncertainty, because he is a real person who does exist in the world, who has a really important job, who's there doing a really important speech, and this is a real thing. So that's what you would assume. Obviously, the policy mentioned in that article was not to do with policy uncertainty, to do with interest rate decisions. It was to do with fiscal policy within the government, which is not his remit to talk about. They're specifically siloed things. So it's a strange question. It's a funny one. It's funny, and maybe this kind of breakdown allows you to understand kind of the speed that Jerome Powell's brain has to be moving at to interpret these questions correctly at the time, and to manage his emotional reaction to these questions and to present in a calm, stable way. It's easy to overlook the effort that it takes to not be acting out. It really does, because you could just assume he doesn't even notice this. But I would argue that he does notice these layers that they're quite obvious, actually, I think. And he's doing a very good job at regulating himself. And what the market's looking at is how he's acting, right? So his job is actually to do this, a real job. And it's actually a real job for that guy to go in and annoy him, because the market wants to see his emotional reaction to it. So his job's actually quite good. And this guy asking the question isn't actually a bad thing. interesting dynamics. Anyway, it continues.
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
And why would there be? I mean, that's the funny thing about that question. He may have actually been giving the guy a genuine answer with regards to the article and saying, that there isn't an awful lot of evidence right now that there is an impact on the dollar value based on the US fiscal policy. And in a sense, you could be inclined to agree with them. There has been an impact recently, which you could have argued, as I did at the top of the show, which might reflect the diminishing interest rates and therefore lower demand for the dollar to be held in US bank accounts and so on. That could be sort of a thing. But I mean, it actually, when you take a look at like things like the US 10-year yield, you can see that this has actually been sustained quite high in the midpoint of this range for the last several years. It does reflect a similar sort of decline. So there's definitely nuances where people are actually, benefiting from interest rates, and it would be more likely to be who cares, right? But this point here is important, that the has not really got an awful lot of evidence to say that US fiscal policy has really driven the demand for the dollar in a historical sense. Because we look at this, and while 96 makes people panic as you go down to it, naturally it would. It's like you're in a dinghy from a lifeboat and you're looking down, you're seeing it's half full of water. Like half full, that's not good. We're in a dinghy. This is halfway. But it's a heck of a lot better than the lows, and it's actually the midpoint of the range overall. The last year has been one of change, and there's been plenty of years of change. Like throughout 2020 into the 2021, there was a big drop in the value of the dollar and a massive rise up then thereafter through 2023 as a response in the way that the world was impacted by COVID. And then that is resolved back down to where it was in mid or May 2020, or indeed, if you want to say back to sort of 2019, 2020 pre-COVID levels and so on. So actually, there's not even an awful lot of evidence right there to say that that's even necessarily happening, although we could argue that it would be. It's just that you could easily look to something else like copper, lumber, and so on and start making arguments about that. Or indeed, you could make the debasement argument, the great debasement argument, or you could look towards gold. You could simply say that the huge rally that's happening in gold right now is infecting so many traders that have gone hyper bullish, because it's constantly days of like what looks like the short side being liquidated and pushing higher. So there's a actual rally in one thing which is directly opposed to like the other, and that's temporarily having an effect on the dollar price. I mean, you could make that argument kind of more strongly than the one that the guy in the question was asking. I mean, what did he expect with the question? You don't know. I don't know.
Anna Swanson with the New York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation?
This is kind of like repetitive. It's a bit of a basic question. It's a bit of a missed opportunity. It's one of those ones where you wish, like, if you're in the room and you'd had all month to think about the one question you would ask, would you ask this one? And if you were, would you ask it in a way which hadn't already had to be addressed by others in the room, and how can you add value? I feel like there's actually no value add here. I'm tempted to skip it.
To soften.
So we'll always be looking at both.
Raise rates rather than simply remaining on hold. What would you need to see to consider hiking?
We don't take things off the table, but it isn't anybody's base case right now. Anybody's base case that the next move will be a rate hike. But ultimately we'll do what we think is the right thing. But that's
you ask the question in a crap way, you'll get a different answer. This time you took the opportunity to answer. This was, again, to do with what you need to see to make cuts. Everybody's desperate to ask that, but they're not asking in smart enough ways to derive answers. He did then say here, and add a bit of color, that it's nobody's base case to rise rates, which is worthy color to add. I think it was actually quite well known already, but it's worthy to add, and it's a way of saving face of the journalist who asked the question. But there was no value add there.
That's not where people's...
Hi, Victoria Guido with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently.
In this one, Jerome says something, and I'm not sure if it's 100% is a slip up, right? And I think it's one of the more interesting ones, but I think there's a chance it's not a Freudian slip, just a verbal slip, where he says, and that's in response to Japan or something along those lines. I'll pause it at the time. I don't think that necessarily he wanted to add as much semantic weight to the answer of that question at the time. This woman does a great job of getting him interested in the question that she's asking.
In part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
You know, over time, you've seen that U.S. rates have remained they haven't moved a lot, really for a while, but they haven't moved a lot because of what's been happening in Japan.
Really for a while, by the way, includes all the way back to the dot-com crash and the great financial crash and so on. That there's been movement. It's been trapped within a range of 5%, and historically interest rates in the US were 5% or more, with greater volatility. And since the 2010s, there's been nearly zero interest rates in the US for an extremely long period of consistency. So that's what that means, whether it's not looking back in the last year, and certainly not talking about like the recent Japanese changes, but it is talking about the recent Japanese changes in the context of the larger picture and how these things have always gone, which is what is of note.
So it's more of an over time thing. The U.S. federal budget deficit is, uncontroversially on.
And cue up yet another of one of the greatest allies to Trump statements. Again, no credit. Maybe he doesn't deserve it. I don't know the political nuances, but this is very much helpful, the statement that he makes here. In fact, I'll just let him say the whole thing.
Happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better.
So the level of debt is not unsustainable, but the path is unsustainable. Now, he said this before too, but reiterating it clearly at a time when there's a room full of people who are asking somewhat hostile questions, and the subtext is no longer subtext for most people involved in this with regards to his replacement and the way that people are viewing his reaction and speed and so on to certain situations. So he says it's not. He reiterates that, and it's helpful because the debt levels are so high right now, it makes people concerned. It gives them uncertainty about the solvency of the United States. However, one of his jobs really is to actually be one of the cornerstones of that confidence in the solvency of the US. Fiat currencies have always been based on trust and confidence in the government. They exist purely, and what fiat means is that it exists because they say it exists, and that's entirely based on confidence and trust. And being able to afford the debt that you have currently is huge. So he's very, very, very politically unconfrontational towards the establishment, and does not create fear with the answer, while being able to deliver the fact that this path is unsustainable.
Right now we're running a very large deficit at essentially full employment, and so the fiscal picture needs to be addressed, and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with, and that in the end game, that's where you wind up, is in some kind of a difficult thing. But that's not where we are. It's not where Japan is either. But it's certainly not where we are right now.
Does it reduce the effect of your rate cuts that longer-term rates have overall not really budged that much?
I wouldn't say that. The thing is, technically, higher longer-term rates means less accommodative financial conditions. But remember, many things move longer-term rates. It's not mostly what happens on the short end. There can be effects of longer-term rates from our moving our policy around, but it's much more assessments of the fiscal path and fiscal policies and risks and things like that move the 10-year around. You can look back at and find periods where we've been very actively moving the policy rate, over the course of a year, and over the course of that year, the 10-year is exactly where it started. So there's not a tight link between, 10-year rates and the overnight rate.
Okay, but on second view, and I missed actually the bit. Maybe I skipped it. I don't know where it was relevant to slip up, or else I misheard with regards to Japan. What was relevant there was about how the Fed decision doesn't really overall impact the 10-year rate. So we want to take a quick look at that sort of thing. You just have to go US 10-year. Here's the US 10-year rate, and if you look back in time on this chart, you will find that there's numerous instances where this has moved around. And the Fed rate hasn't, or the Fed rate has moved around and this hasn't. And it's not necessarily directly linked. Likewise, fiscal policy in other nations does have an impact, especially if they're involved in the buying and selling of bonds in the US. And they do keep a track of these things and look at them, and they will be responsive to anything that happens and always have been. But at the same time, it's an unfair correlation to make at the level of strength that it's being made at, and that's especially over the longer term picture, and it always has been, in fact. So it's really not his job.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Republican Senator Tom Tillis, who sits on the Senate Banking Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
More.
Again, another person who spent all day waiting for the chance to ask a question at this really important event, and that's what you get. Well, okay, fair enough. It's made abundantly clear. He wasn't going to talk about politics already, but there you go.
Broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
And again, this is just an interesting question to the kind of average household in America, if the implication that is about to happen or some such along those lines, but really not an interesting question to the average household in America that really doesn't give two Fs about economics, or or macroeconomics, or how the relationship between these things work. This is what. So the impact on their households, well, that's a real political question, and that's an interesting one to have to hurdle.
So really, the point of independence is not to protect policymakers or anything like that. It just is that every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well, and that is to have a separation between, to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, through an election cycle to affect the economy in a way that will be politically worthwhile. So this isn't, I'm not talking about the U.S. context, this is every advanced economy democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, first of all, it would be hard to restore the credibility of the institution if people lose their faith that we're making decisions, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident.
And that's important. He puts it towards the public, and the role is the remit is to help the public, and that's two big bodies in America that are there to serve the public, and they do it in their own mandates, and they sometimes work together, sometimes conflict a little. So sometimes one helps the other up, sometimes the other one's restrictive on the other, all in a spirit of good teamwork for the best interest of the American people overall. And that's actually the best system that you'd want to have. And one notable sentence from the entire thing is he said that we do not exist, to protect politicians. And he could have said it the other way around. So the language he chose to use was neutral to positive, when it could have easily been phrased the same way, the other way around, and been negative, which would have furthered the division between the Fed and the government. But this way is a far more cooperative statement, I guess, if you wanted to, but basically all he's done there is give some economy 101.
It can maintain that independence at this point.
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Archie.
Archie Hall from The Economist. On that sort of stabilization of the labour market question, how much do you see the weakening we saw over the past 6 months, year, as a kind of data mirage around immigration and the government shutdown and so on that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labour market, do you think?
Now, that's not a regional UK accent. Very much went to different schools, those two, Claire Jones and that guy. It's an interesting question again here, and it's an opportunity for them to kind of provide a narrative behind the lack of acknowledgement around the Sam Trigger ruling, and say things like, yes, of course, that was to do with mass immigration, like deportations and so on. Of course, that spiked unemployment and so on. But again, you know, you're getting kind of political with your answer, so it's a bit of another minefield to get through. And you know, there's some body in this question.
Well, part of it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. You know, supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other...
Good example of when I don't know is the most confidence-inspiring answer to a question, by the way. You can acknowledge that there's been impact, and you can acknowledge that you're monitoring it, and that you're aware of it, and interested by it, but that you don't actually know the exact outcome from it. And I think that's the best stance for them to take on that particular question. It is somewhat interesting.
Things like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, you know, it shows, it's a survey showing that workers feel like job availability it's a very low reading. It's just one reading, but it's an indication of softening. People, part-time for economic reasons, which is a category within the broader U6 category measure, has moved up significantly. So there are lots of, and I could go on and on, there are lots of little places that suggest that the labor market has softened. But you're right, part of payroll job softening is that both the supply and demand for labor has come down. Growth in those two have come down. So that makes it a difficult time to read the labor market. You know, so imagine they both came down a lot to the point where there is no job growth. Is that full employment? In a sense, it is. If demand and supply are in balance, you know, that you could say that's full employment. At the same time, do we really feel like that's a maximum employment economy?
And that's very interesting, because he's really taking you to the precipice of saying, and of course then the Fed would look to then lower interest rates to create growth so that there was better jobs out there that were available and that people would want them and would look to get them. But then at the same time, it's a hypothetical. It's a very unusual hypothetical, where it's just that the demand and supply have leveled out so much that there is like this zero figure coming up. And it's like, it's a curious question. I mean, is that even something we have in the future to look forward to, with the impact of AI and the fact that nobody wants to have kids anymore? Or do we see things like that happening and being measured as part of an official measure into the economy, you know, quarter to quarter, that they look at? Who knows in the future? And right now it's a sort of, it remains just a hypothetical, but it does shine a light on the complexities of the muddied water in the data over the last sort of 6 months.
You know, it's very challenging and quite unusual situation.
Thanks. And one more on growth and the kind of strong growth outlook, or strengthening growth outlook you're now seeing. How much of that is the fiscal stimulus we're seeing from the beautiful bill, the tax cuts, and all of that?
So you're seeing it already. You don't have much of the fiscal. I think the outlook, you're right. It's financial conditions, and it's fiscal policy for 26. But you've got strong consumption that's been happening before financial conditions have been supportive, but before the fiscal effects really are shown. So essentially the economy has once again surprised us with its strength, not for the first time.
It's quite important is that you see that he's talked about fiscal as being separate again, and that it's not his silo to be operating on that world. he's commenting on fiscal because they have to, of course, respond and react as things are happening. And it's important to understand, if you are seeing growth, is that real? If you are seeing contraction, is that real? What's it based on? What are the metrics behind it? This question asking, is a lot of this growth coming from things like the big beautiful bill, and to what extent is it or isn't it? And he says, yes, there are these fiscal things, and that is interesting, and we do monitor it. Our remit is in terms of looking at this other data, for example, consumption, which we saw was high before this bill came along. So they're operating on that data, which is important in other questions when people ask about the types of data that they use and whether or not their model is any good or not, is that they have a remit, a silo they operate in, and it requires them to use specific types of data to understand the outcome. So he's interested in consumption, whereas somebody else is talking about that in terms of like growth with regards to fiscal policy, and he's looking at it with regards to retrospectively looking at the data that's come out of the economy and whether or not consumption is strong, demand is strong within the economy itself, regardless of the fiscal policy, which would either amplify or diminish that. So it's an interesting thing. It's worth pointing out. I suppose this is kind of more educational than looking at like the specifics of right now. That's the conversation these journalists are having with him, though, and that's my commentary reflection on that.
And, consumer spending, although it's uneven across income categories, but consumer spending overall numbers are good, and we're benefiting from the AI build out of data centers. That's another thing we're benefiting from. But the economy overall, the growth is on a solid footing. It looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative and then spending. So there's been a disconnect for some time between downbeat surveys and reasonably good spending data.
Thanks, Chair Powell. Christine Romans from NBC News. You talked about how consumer spending is uneven. The president calls inflation defeated and solved. The FOMC says it's a somewhat elevated inflation. But you talked about those customer survey or those consumer sentiment surveys and public opinion polls that show that most families say the cost of living is still issue number one. What is the conversation around the table with your colleagues about how wealthier consumers seem to be driving so much of the economy, and why so many families still feel like they just can't make ends meet after 5 years of rising prices? What is that discussion like?
Which is an interesting, another way of saying the same conversation we've been having on the show. We talk about this all the time on the show, but she's presenting it through the perspective of like the lay person in their home in America asking about this question. They just can't articulate it the way that we discuss on the show very often. We've been talking about the disconnect between the S&P 500, within that, the top performing companies like the Magnificent Seven, the tech companies, and the RSP, which is the equal weighted S&P 500, and where the growth is, and the Russell 2000 and the middle belly of the economies, the ones that pay your mortgages, and and how there's this disconnect between the kind of the elites and everyone else. And if you just look at the overall aggregated figure where you average out all the elites and everyone else, you're going to come up with an average that looks fairly favorable. But ask everyone else and you'll see that they're not elite and they're not living that life, which creates that average. And it's an interesting question, I suppose, and the way that it's asked in such a sort of domesticated way is interesting.
So a couple things. One, there's something to it in that we know that higher income households that tend to own real estate and tend to own stocks, securities, and those assets have been going up in value, and increases in wealth do support spending over time. So, and that's clearly a part of the story. We also know that for some time now, for a year or more, we've been hearing from retailers, for example, that serve lower income customers, whether it be food or the big box stores or anything. They're saying the same thing, which is our consumers are looking to economize. They're trading down from brands and they're buying less, and it's changing their buying habits and that kind of thing. So we're seeing that, and that is a reality of what we're seeing. They're still consuming, but they're feeling it in a different way. I would say more broadly on affordability, we have a vast network through the reserve banks and also through the Board of Governors where we talk to small and large businesses and households, and so we do hear a lot about affordability, and we take that very seriously, and we take it to heart because one of our jobs is price stability, and so the best thing we can do for people who are feeling that squeeze is to keep inflation under control and frankly to finish the job of getting inflation back down to 2%.
And that again goes back to the silos difference between the Fed and the fiscal policy. Isn't for the Fed to be able to say there's too many billionaires in our country or some such like that. That's something that the politicians can say. They're not there to control the policies which create that, but they do look at the effect of the economy has on people's lives, and they are very much aware of it, and they do what they can do, and they have a job to do, which is to make sure that that family that's finding the cost of living crisis difficult has the availability of a job, and to make sure that the inflation, the money they get paid for doing that job, doesn't become worthless too quickly. That's their only job. And yeah, there's a lot of interesting stuff to be said about billionaires and fiscal policy surrounding tax and so on, but none of that is his job. The only job he can do, the only thing he can try to do, is to work on bringing that inflation down and creating those job opportunities in terms of demand and supply. Again, he can't even operate on a fiscal level to stimulate employment. That's not something you can do.
You mentioned the AI build out as being positive for economic growth this year. I wonder, as you look at the weakest year last year for job creation of a non-recession year since like 2003, are you concerned about AI maybe supplanting more entry-level work and entry-level jobs, and how does that play into what you're watching about the labor market?
So everyone, of course, is watching AI and the deployment and, trying to understand exactly what's happening. And there's a wide range of possibilities. It's hard to say. And of course, anyone who uses it is amazed at what it can accomplish, right? So every technological wave will eliminate some jobs and create other jobs. And it's always been the case. If you look back, wave after wave after wave, there will be some disruption, but ultimately technology increases productivity, which is the basis for rising wages. And it may not all happen immediately, but over time, it's what enables incomes to rise over time is rising productivity. So we always ask, well, this is going to be different, is it going to be different? And we don't know. And we may, in any case, see in the short term jobs that are being eliminated by the capabilities of AI. We may see that.
My auntie met her husband because she was working as one of those ladies in the phone, when you pick up and you speak to the operator, connect me to Houston or whatever they would say. And then like, who's this, a space agency? Yes, connect us to the rockets. And then they take the wires, they pop them in, and it's like, hello, is that the rockets? Yes, the rockets. And that's how the phone calls happened before people had telephone numbers and so on, that type of thing. Yeah, my auntie was doing that job, and he'd phone up and they'd chat, and then they ended up getting married, which it's almost like, it's almost weird, to be honest, from a modern perspective. But things were different back in the day. Well, anyway, are all the romantics out there sad that I can now pick up a mobile phone, put in an exact number, and call it? I don't have to speak to somebody in the middle. Am I missing out on my potential soulmate wife because I didn't chat to the operator between being connected to whom I actually wanted to phone up to in the first place? Is that a detriment to my life? Should I be here? And that's where you start to sense that there's a degree of like hysteria when it comes to people being afraid about technology advancing. Productivity is good. You got to hope that these companies that are using AI are doing it to make the jobs of their current staff easier so that they can perform better, because there's more ROI in every member of staff if their life and job becomes easier. You don't need to sack them all. You just need to get the business to grow. And I think that's the underlying hope that still persists. And actually, the data is showing that that's mostly the case.
We just don't know what the overall effect is going to be. So how to think about it in macroeconomic terms, it's very hard. We can look at the aggregate data. We can analyze, for example, there is some connection, it appears, between the low hiring rate for recent college grads and AI, but it's not the main or only driver. You hear large companies, though, many of them saying that they either won't be hiring for some time, or that they're hiring less, or that they're laying people off, and they tend to refer to AI when they do that. So we're all watching and learning, and it could certainly have pretty significant effects on the economy, the workforce, and our society. We don't really have the tools to address the concerns that may arise, but we have a lot of people who focus on analyzing it and try to understand what the macroeconomic implications are, which is our job.
Beyi. Thank you, Chair Powell. Beyi from AFP News Agency. You mentioned earlier that on inflation, the broad expectation was for a one-time price increase and then for inflation to come down. And I was wondering, is your expectation still for inflation to start cooling in the second half of 2026? And if you could elaborate how far we are from target currently. Thank you.
So how far we are from target is, as I mentioned in my opening remarks, we had 3.0% core PCE inflation over the 12 months ending in December, and that's pretty much what we had the year before. So on net, no progress, but the story behind that is modestly positive in that most of the overshoot was in goods prices, which we think is related to tariffs, and ultimately we think those will not result in inflation as opposed to a one-time price increase. Okay, so that's where it is. In terms of, you asked, no one thinks they will, ex ante understand really clearly, precisely when this will happen. But there's an expectation that sometime in the middle quarters of the year, we'll see tariff inflation topping out. So what we do is when a tariff is put in place, we track the effect of those tariffs over a 6, 7, 8, 9 month period, and you can see for that tariff how long it takes to reach a place where it's affected the price level, and that's it. So we're getting better at that, and our estimate is that it'll be sometime in the middle of the year, but I wouldn't look for great precision in that. But we'll be able to see whether things are moving in that direction. I think we'll be able to see.
It doesn't take a genius to work out that the rough penciled in maths on this is tariff imposition date plus 1 year, make no decision at all until it's been at least 6 months. Look at it at 9 months and then try and determine after 12 if it's gone away. So looking towards the middle of this year, when we'd really made it over the biggest kind of chunk of the crazy tariff hysteria that we had the first half of the year, you would then look to see if those figures have played out. And by the same token, if you put in any new tariffs, they probably won't be doing it until there's been 6 months, 9 months, and then a year. And I think that's fairly clear subtext, but it takes a lot of the same question being asked again. Can't say that person added any real value there, but there you go.
Richard Escobedo.
Thanks, Chair Powell. I'm Richard Escobedo with CBS News. I want to look outside the U.S. about what's happening outside our shores and how it impacts the U.S. Canada's Prime Minister said last week that there's been a rupture in the global order, and I wonder how you're thinking about geopolitical risk as it relates to the U.S. economy.
So I can't comment on that speech.
I mean, have you been paying attention to the entire press conference so far? Anyway, yeah.
Speech or statement or anything like that. Geopolitical risk for us is, a lot of it is around energy, oil. And so far we haven't, for all the turmoil, oil prices have come down, as you know, and so we don't really see much.
And then he comes through with a surprising answer, actually delivering value there. Surprise. It's all to do with oil, and haven't seen that happening in oil, so what can you say? The numbers aren't there.
Longer than that, it's trade, and the trade, our economy has has pulled through pretty well, you'd have to say, given the very significant changes in trade policy. The U.S. economy has pushed right through. Partly that is that the way that what was implemented was significantly less than what was announced at the beginning. In addition, other countries didn't retaliate, and in addition, a good part of it hasn't been passed through to consumers yet. It's being taken by companies that stand between the consumer and the exporter. So.
Although, interesting contradictions, I think, in Jerome's speech there, in that he finished up the last question talking about how technology can increase productivity, which is a benefit to society and reduces prices for everybody. In the question prior to that, he discussed how immigration has gone down, which has reduced labor supply, and described that as a positive thing, which is a change from the orthodoxy the Fed would normally use. They would say that
it's not. It's that what happened there was that the demand for jobs increases wage inflation. So reduced job demand reduces wage inflation over a period of time. So in a sense, it's a good thing, but he's not saying ICE going chucking people out or having some political comment on it. He's just saying that reduced demand for labor, for jobs, from the reduced demand within the labor market as a result of less immigration into the country.
Yeah, but he's not talking about demand. He's talking about supply.
He was saying that supply has dropped as well.
Labor force, and it's dropped, which is it is a change from the previous orthodoxy, because that was similar to the suggestion about technology increasing productivity. Previously, it was suggested that lower aggregate wages.
Oh no, you're right. Yeah, no, you're right. You're right.
Output.
Sorry, yeah, you're right. I just thought about the wrong way around there. Yeah, no, when you're saying that there should be more people, there should be more people. But why was no? It's confusing because there has been weakness in the economy where there's been less jobs available, but the overall unemployment figure would be much higher and growing much higher if there was the immigrants weren't being thrown out as well.
Right. So what he's saying is supply
and also
dropped.
Unemployment figures are higher potentially as a result of the immigrants being thrown out. So reconciling how many new jobs have been created, how many jobs have been created that are not being filled by people who no longer even are seeking a job, and how many people want a job but are demanding for the same type of job in the same industry.
Right. This is where I think he's skirting over something that reveals quite a lot about his thinking. Like, he's not saying, like they previously would have been said, that increased workers and less wages is positive because it reduces costs while increasing aggregate productivity. And instead he's saying that he's implying that Trump's policies have been positive in that immigration, with its macro impact on wage pressure, has actually led to capital shallowing, in that instead of that productivity increasing and then prices therefore coming down, instead that money has been pocketed by the businesses themselves. So he's talking about how, while it might have been beneficial for individual companies to have immigrants, it's actually been caused stagnation in the overall economy to have those lower wage inflation from immigrants, which isn't necessarily a political point, but he's making it at an incredibly political moment.
I suppose, yes. This is why I'm saying that there's a hidden thing here where Trump, where regardless of whether he hates Trump personally or not, he's ended up being Trump's big ally, and regardless of whether Trump hates him or not, he's come in and shored up so much. Or Bessent as well. Bessent looks like such an amateur fool.
Fucking hell.
But then give it a week and give Jerome Powell a time to talk, then Bessent looks less like the idiot that he looks to people on initial view. And it's like, and it is interesting. I don't know if there's a subtle political thing there or not, but he presents as using real data all the time, and trying to maintain his integrity on that above all. And there is a choice he can make in terms of the semantics and the way that he presents anything he says. And he could have been negative at times, or he could have said some key buzzword that got somebody to interpret even what he's saying. He said that word, so even if everything he said it's all rubbish. So but he hasn't done that. And there's a really interesting one with regards to the immigration thing. It's a sort of you'd need to kind of look at maybe perhaps in the written word of what he said to try and pick it apart to see where the focus was. Reduced demand for wages happens when there's less people to employ, so you have to compete with other people who are already employed as a thing. And it is such an incredible flux in the employment world that if there's employment rising, but also there's actually are more jobs available, and the people don't actually necessarily want those jobs who are doing something. It's such a strange thing to pin down exactly where it is, because the other things aren't.
Well, it's led to stagnant wages, and this stagnation in the wages is part of the problem with the cost of living.
Well,
and
previously,
because of that, simply just to, partly what explains why he's making a political point or making a neutral point during a highly political moment is that workers know their wages are stagnating, certainly in specific income brackets, and so they understand as prices increase, whether it be 2% or 3%, and their wages are stagnant, their cost of living is increasing. And that creates this discord between the economic narrative and the reality by most people, because of course most spending is done by higher income brackets, and that's what's driving the economy. But the real life experience for most people isn't that. And so there's this narrative disconnect, which ultimately, whether he focuses on data or not, can lead to a sort of a lack of credibility in his messaging if it isn't experienced by people. And at a point in society when it's highly political, maybe there's a requirement for him to turn that.
No, I think that has happened. I think that's happened. Like a lot of the hits on his credibility haven't actually come because Trump has said he's too late Powell. That's just a nice thing. The hit on his credibility has always come from real lives of people day to day, and they don't think about the Fed, but then they hear about them and they think, oh, it's been 6 months since I thought about them, and my life's got worse since. But it is an interesting thing there when you think that there's that side of it that you're presenting with regards to how there's been this stagnation in wages. I'm not 100% sure in the math or anything on these specific points, but it's interesting. But also there's the other side to it too, which is that the point really should be that wages should be going up because productivity has gone up and the company's made more profit, so it's paying its staff more money. And it isn't going up because nobody else wants to do the job that you're doing, and they have to hire somebody to do the job from some other company.
Yeah, and productivity is, like you discussed before, economics is about productivity, and productivity is about output. And in those instances where it's about spending for no actual output, that's negative for economy. Like, for example, buying bombs.
Yeah.
And this is a similar situation with these.
Well, the problem with the American economy in so many ways for years has been that there's been, I mean, they like to talk about GDP over there, but there's an awful lot of Starbucks employees that are not contributing any production to anything in the world. And every hour that they get paid is GDP. So like when people are being paid for like service industry things, then you can't tie it back to like digging a rock out of the ground, and you can't say that some production has happened, which is a bit of a disconnect from the early models of like productivity and like being able to take wealth either from your natural resources or like above the ground, growing sheep and taking their wool off them and so on, exploiting the resources that you have and creating wealth. And people then associate wealth with like hard production levels. And then but relying on GDP figures and GDP growth and so on, as he says at one point, is a mess. But like this whole gross domestic product, when so many people are working for Starbucks or taking your dog for a walk, it's like, where's the productivity there?
Yeah, and then it raises this question. I think it raises a question that has the Fed made a tiny shift in its philosophical approach? Because it used to be said that the best employment scenario or the strongest employment statistics would be maximum employment, or at least an efficient employment market was a tight market. That would have like a lot of people in work and a lot of available jobs.
Yeah, but maximum employment has never meant 100% employment. This is the thing.
Okay, but now it's changing from even searching for that sort of misnomer. It seems to have been discarded, and instead they're looking for resilient employment stats. So resilience the strength has changed from efficiency to resilience in some aspects. Perhaps that's hinted at philosophically.
I don't know. I mean, the world's changed so much over the last few years. It's like things like these 1 in 100 year events that have happened that he goes on to talk about in his Q&A here changed the world, and it changes the way people think. And it's like, there could be flavors of that. It could be personal to him and his speech, and that the next one would never mention it and it just fades away. It could be that all 19 of them or whatever are talking about this as they meet up every time. So like, what does it mean? I don't know. It's interesting, but it's the same thing as before, you know. He did say that he says things at the time for the time, and then in 3 months' time, somebody might say to him, "You spoke about this in the past. Why are you not talking about it now?" And he says, "Well, it's not
that's what
relevant
he's done
anymore."
now recently, I think but that's what kind of what I'm also getting at, is that he speaks for the moment in the moment, but he's also speaks about how they monitor everything, and you've seen how they model tariffs, and he's also touched on how they model in AI's impact on the employment market, and even looking at subsections of how it affects graduates, and how there's a decrease there. And he speaks about it in a neutral tone, because maybe what he means is that a strong economy includes a strong workforce, which means resilient workforce, and resilient in the face of technological improvements, which will increase productivity, and how, in order to sustain that in the face of cheaper labor elsewhere, inflation in America, all the new technology available, and the lack of people seeking employment in America, means that in order to have a strong, resilient economy in future, they need to invest in capital. They need capital expenditure in these new technologies, which will increase productivity, which will come at a cost to the number of people they employ. But that leads to a far more resilient workforce in future, as opposed to one that can be undermined globally and has these other macro impacts on the economy. So,
well, I mean, but what is that you're saying there? Because like, what was the?
There's maybe a focus from Jerome on the idea that in future a lot of people are going to be losing their jobs, but that actually is good for America.
Yeah.
Well,
like that's like, well, the thing is, it's good for America in the sense that if America wasn't, you know, getting an overdraft and spending loads of money on chips that it doesn't need yet, just so that China, and restricting the ability to export them to China and developing the latest AI models and so on, then it wouldn't be ahead of China. China would be ahead of America. And just like the EV market, with people genuinely losing their jobs in Detroit because the Chinese vehicles were so much better and cheaper, that they had this radical change where we're pushing towards lower gasoline prices and really embracing the carbon again, is as a reaction to that. It's as if to say the EV revolution in America failed and all the jobs went to China. And if you said the same thing about AI, which is like, a Chinese person doesn't even need to speak English at all anymore, and all the jobs could move to China. It really is important that it's like, if everybody at the end of the world, if the tractor destroyed farming jobs, but only one country in the world was allowed tractors, then sorry farmers, we're getting the fucking tractors is kind of the point. So it's like, it's a tough one to
it's
present.
interesting times, and like you say, Jerome compliments Trump.
Yeah, exactly. And it may well be fully known by the pair of them. Like, it may well be. It's why I keep hinting at this. Trump gave him the job in the first place.
Isn't it such a shame that in parallel to that economic progression and that wide, open, positive view of the future of America, it takes society dragging and kicking and screaming and shooting each other in the face along with it. Like, there's no... people can't be open about the future, because if they are, it changes the actions they have to take now and compromises the potential.
That's inflation
benefits.
expectations, man. I mean, it's such a difficult... How do you say, when everybody in the room is asking you, are you going to cut rates by mid-2026 because you're forced to, because either the jobs market's got so much worse or inflation has gone down because it was only ever tariffs anyway and you're proving you're too late? And that's the question everybody's asking him. And yet he has to combat against this here, because every time he says, yeah, that's right, this number goes way up, inflation goes up, and it causes massive problems. And it's like, so it's like the whole thing is like so complex that a surface level reading of any of it is completely inadequate. And the truth is, the sort of third level down that you go is full of conjecture, trying to find a happy medium in the middle where you can understand the subtext of what's being talked about and the limitations around, you know. You can understand that he could say X, Y, or Z, but if he said X, it's too little, and Z, it's too much. You're listening to see, does he say Y? And these are the things that we're getting from the chat here today. But it's super complex, and any surface level reading is completely inadequate.
Well, he's done an amazing job. thanks very much for having me on there. Keep up the great work, right?
Cool. Yeah, well, I'm going to finish this Q&A session, then I'm going to do a bit of quick kind of look at silver and gold because it's so hype at the minute, and I did promise people at the start of the show that we would do that. But let's hear it. We've not got that much longer to go on the things. The next sort of 5 minutes on this thing, and it'll be wrapped up. And the most interesting questions on it actually do happen towards the end. So we'll just let him pick up where he'd left off.
That's where that is.
That's where that is.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With third quarter GDP growing at 4.4% and the fourth quarter expected to have a 5 handle on it as to what the Atlanta Fed is predicting, at a time when you had a government shutdown and we thought that was going to shave off some growth, you've also got the fiscal tailwinds you've talked about, big tax refunds coming, potential tariff dividend. How could you cut rates and not spur inflation in that environment?
Now, I don't know what political motivation she might have, and everybody seems to at the minute in America. I don't know. I actually live in my own world, where I don't assign political motivations. That's a pretty good question. It's a really good question, regardless of who's paying our wages. I don't know. Surprisingly good question towards the end of the show. It's flips the narrative, right? Because everybody else in the room is asked whatever, and maybe she's the one person, and I've made this joke a couple of times, you're sitting in a room waiting all day to ask a question, could you not think of a better one? Maybe she's sat there thinking the same thing and come up with this. I have full respect to this person for having asked it in a different way.
Well, we didn't cut rates today.
And that's the answer that you get. I mean,
it depends on how fast potential output is growing, right? I'm just asking in principle. I'm not saying this is what's happening, but there's growth and there's how fast the potential is growing, and at a time of high productivity growth, potential output is rising. So it really matters whether potential output is growing as fast as actual output, and it would matter over time. The numbers you cite were for quarters, and quarterly GDP is, you need to look at 12 months because quarterly GDP can be very lumpy. GDP was negative in the first quarter last year. So the overall, over the year, the numbers were nothing like that. It was more in the mid-2s for the year.
And
super interesting answer. The fact that GDP is a bit all over the place is interesting, but also the fact that you kind of need to, maybe he wasn't very clear here, but what you kind of need to do is make a forecast and then see if you achieve that forecast. And some of the data that they're working with is very bleeding edge, new edge stuff. Like, how do you predict about AI and stuff like that? How do you predict about tariffs? These are big things that haven't happened for a long time. So, or ever in some cases. So modeling for the future is difficult. Assessing afterwards how accurate you were is pretty good. That's helpful. But again, it's only one reading or 2 readings. You need to do it over time because your model might have just been coincidentally accurate, or you might have modeled it and then not implemented what the model was suggesting just so that you could establish that there is indeed a model to work with in the first place. So these things happen over time, and well, there you go. How could you not increase inflation in an environment like that was the question, and the answer was we didn't raise rates. And that's because they're waiting until next time to see how they can get by, and if they can lower rates without raising inflation, then they'd be inclined to think about doing that.
how do you explain the divide right now between strong economic growth and the job market? Is it productivity that's filling the gap? And is productivity being driven by AI at this point?
So there has been, you're right, there has been a divide of solid growth, but what looked like a weakening labor market. And that can be explained by rising productivity. But I would say we do see signs of certainly of the unemployment rate stabilizing. So it may be we're seeing the beginning of the resolution of those two things. Also, as you probably know, the lore is that when GDP and the labor market get into an argument, in the end, the labor market data is more reliable. GDP data is just very hard to collect and understand, but nonetheless, I think we may be seeing that tension resolving a little bit. Too soon to say with any confidence, though.
And the data they have to look back at it retrospectively. So they make a forecast and they see how it gets on, and then they look at the retrospective data. And in the end, GDP often gets revised like 3 months after they release the figures. Very often, you don't get the revision until the next quarter. Happens all the time in the UK. It was a real period there, maybe for 18 months, where it was revised every single time in the UK. It was pretty mental. But employment figures are employment figures. You know, if you're paying out that much social security, then you know how much social security you're paying out. Interesting.
Matt Egan.
Matt Egan with CNN. Chair Powell.
Oh, and on the point as well, AI productivity. Again, you think because you're able to write your emails quicker, you're somehow being more productive. It's an interesting one, isn't it? Sometimes that is true, because at the end of it, more solar panels get delivered to customers or some such. But often as well, the productivity, if you're measuring it as GDP, includes every single Starbucks employee. I'm sorry if you work for Starbucks that I choose you as the useless employee, but every single person who's just paid a wage for doing something that doesn't provide anything to anybody really, and it really is as the GDP as well, you know. So
well, after
like wage rises, historically high wage rises, which is what the previous 2 years were like in America, actually since 2020, really historically fast rise in wages, which is why people they didn't really notice the cost of living crisis till it caught up with them, but the wages rose really fast. They add to GDP. Every time that average wage goes up, it adds to GDP, of course.
Today, you have 2 meetings left as Fed chair. You've obviously experienced a lot during your time as Fed chair, served under multiple presidents. I'm wondering what advice you have for whoever your successor might be.
Funny this, because Martin O'Neill was asked the same thing whenever Wilfred Nancy was taken over as the Celtic manager back at the end of last year. And as you know, if you're a regular fan of this show, I'm a Celtic Football Club fan. And this guy was the big, most important, wonderfulest, bestest manager from the United States, came over to take over at Celtic Football Club. And the legend that is Martin O'Neill, a great steward of the stalwart Celtic fan, and came in to be to be interim manager for a while. And he was asked when he was leaving, just as Wilfred was coming in, what advice he would give. And he was really respectful and basically said nothing, which is funny because Wilfred Nancy was sacked then 33 days later, 4 days less than Martin O'Neill had the job previously as the interim, and then Martin O'Neill was rehired afterwards. And you got to think, hey, buddy, maybe you should have given him some of that advice that you didn't give. But it's respectful to not give people advice. He kind of says the same thing. Well, actually, no, he doesn't. He gives 2 pieces of advice, but one of them...
Honestly, I'd say a couple of things. One is stay out of elected politics. Don't get pulled into elected passive. It's easy to criticize than work at the Fed.
This is the other bit.
You're about to meet the most qualified group of people you not only have ever worked with, you will ever work with. And when you meet Fed staff, and not everybody's perfect, but there isn't a better cadre of professionals more dedicated to the public well-being than work at the Fed.
And I thought that was quite pro-Trump ally as well, because the guy that they were planning on replacing him with, got given a job there already, and he's included in those things there, and he's given a lot of respect to the person who has got, touted as being politically and motivated very, very differently to him, and has a different view on markets, yet he still says he's one of the most intelligent, best, wonderfulest people in the world. And I think that was worth leaving in there. But,
you may take from these significant price increases we've seen for precious metals.
Don't take much message macroeconomically. The argument can be made it's that we're losing credibility or something. It's simply not the case.
So, question: high gold, silver prices. What do you take from it? Answer: argument could be made that we're losing credibility, which is the debasement thesis, because it's not actually Roman times where there's actual debasement of the amount of silver in a coin. That's not actually happening. Ever since the 1970s, when you went off the gold standard, it's always been based on trust. It doesn't matter if there's how many dollars exist. If there's one or if there's 25 trillion billion dollars out there, makes no difference. And there's no such thing as debasing it down in the amount of metal that's in the coin. There just isn't anymore. The only thing that you can debase is the trust in the government. That is the fact of fiat currency. It might seem like a philosophical, like Plato's take on economics. It isn't. It's the reality. And he addresses that right there, I think, quite stalwartly.
If you look at where inflation expectations are, our credibility is right where it needs to be. So we look at those things. We don't get spun up over particular asset price changes, although we do monitor them, of course.
And the asset price changes he was talking about was precious metals. And the question has to be, is there a massive debasement in the trust in the US government? Jerome Powell tried to answer that there now by saying no. And gold is just about to, or either just has, hit 5,500. Which is historic massive levels. I mean, is this a blow off top? Will there be a pullback on this at some point? We'll be discussing that in about 5 minutes. 2 minutes.
Nicole, for the last question.
Hi, Nicole Goodkind-Barons. Some prominent critics have charged that the Fed's economic models are somewhat backward-looking, but should be more forward-looking, incorporating things like productivity increases from AI. How do you incorporate current and future developments into your analysis and decision-making, and do you have an answer to those critics?
Yeah, so by and large, those criticisms, as somebody on the inside, they just don't make sense, and I'll tell you why. Every FOMC participant writes down a forecast every quarter, right? The summary of economic projections. And that's the basis for how we think about the economy. So, and the other thing is...
So everyone is looking forward, then predicting how they think the next few months will go, and then they meet up in a few months and see, did their forward projections actually tally? And if not, why not? And by how much? And what decisions need to be taken off of that result? Is inherently forward-looking. Depends on what particular data you use. If you're going to talk about leading indicators, then for every step forward in time you take, you lose a step in reliability of the data. This is a conflict that's existed since the dawn of time, and this is why he has this very thorough answer to that question, which I think it does warrant being asked, because it was, of course, Jerome himself who brought this up back in September and went to the side. Now, he can't say, I said that in September so that people wouldn't worry when the inevitable government shutdown happened a couple of months later, because that reveals behind the curtain. And any end of Wizard of Oz moments in the Fed are bad. People don't like that. So you can't break the fourth wall. I can, I'm telling you. And that's what he couldn't say, but that's what the actual answer would have been. And instead you get this, which is quite interesting.
What an economic model can do is it can grind up all the data for the last number of years, 50 years, let's say, and it can identify what are the relationships between variables A, B, C, D, and all that kind of thing. And it can tell you, if you change one of those variables, this is what should happen in the macroeconomy. That's just the way it works. However, the structure of the macroeconomy is constantly changing. For example, we hadn't had a pandemic in 100 years. It wasn't in the model. And we knew it from the very beginning. It was not in the model. A trade war of this scope, we'd never had that in 100 years. And so there's great uncertainty at different points. Another thing I'll say is, when it comes to, technological developments that raise potential output, some kind of technological revolution, like happened in the 90s here and like maybe happening now with AI, we're all over that. And
the 90s was the internet, by the way. You might have thought for a second he was talking about the movement towards VHS over Betamax or someone else. No, the technology he's talking about there was the internet.
And everyone studies those periods, and we're very clear-eyed about the possibility that this higher productivity may persist, and also that it may not. We're not. No one's sitting here unaware of the possibility of higher productivity. We've been talking about it for 3 years. It long predates the current situation. It's been going on for 5 or 6 years. We've had productivity higher. We've been talking about it that whole time. So it's very much on our minds, and we are well aware that higher productivity means higher potential output, and it changes the way you think about potentially inflation, growth, labor market, and all those things. That's all in our models. I mean, if it's just a question of using better models, bring them on. Where are they? We'll take them. But I think, we certainly are in contact with anybody who does economic modeling, and we're always looking to do better at that. But that's how I think about that.
That doesn't mean he's getting secret messages from pinko commies, by the way. Just normal Western Keynesian economics is probably what he's looking at there in terms of who's sending the messages.
And just a quick follow-up. We've been talking a lot about tariffs and passing through, and we've been talking a lot about them for the past few months. You know, the trade landscape is still in a constant state of flux. Announcements, threats, negotiations, they're all frequently changing. So I'm wondering how you actually track these, what data or channels are most critical to follow this in real time?
Trade?
Yeah, the impact of tariffs and how they're changing.
Yeah, I think our staff has done a really nice job on that, and they've kind of put it together in real time. So as I mentioned, a tariff gets put in place, you can pretty much track its effects on pricing and on everything, and so you build a model up from all of the tariffs. At the beginning, it was very much of a forecast. Now it's every cycle that goes by, it becomes more informed by actual data, and you know our forecasts were not far off. What changed was, as I think I said earlier, what was implemented was smaller than what was announced. In addition, we didn't see retaliation internationally, and I think people did generally expect that because we saw that in the past.
Which was a much more professional way of saying it than Scott Bessent did, where he was all like, don't punch back, don't punch back. It's so weird. Anyway, like I say, his calm and erudite, eloquent explanations of things really do an awful lot to complete the circle on the things that have been said from other parts of the government.
And that really mattered, too. And then the other thing is that pass-through didn't know how fast that was going to be to consumers, didn't know how much exporters would take, how much companies in the middle would take, and how much the consumer would take. And it turns out it's a lot of companies in the middle who, by the way, are pretty strongly committed to passing the rest of it through.
So they've been taking it so far. They're strongly committed to passing the rest of it through. It hasn't happened yet. We're not out the back of the tariff thing. Still waiting to see how it goes. That's what all their modeling suggests, that there's going to be some impact on inflation within the next 6 months as the rest of those things get passed through. Any further increases in tariffs would obviously be a massive setback in terms of this process of moving through.
Which is one of the reasons why we need to keep our eye on inflation and not declare victory prematurely.
Thank you.
We're done?
We're done.
We're done.
Okay.
And that's a thing. I'm going to hit the like button on this video and encourage everybody watching my video to do that too, if you wouldn't mind. It might help out there. And we're going to do a quick bit of analysis on the gold and silver charts. There's been some great chat in the audience there from people, just kind of showing some from Jamie there and others. So really appreciate everybody that makes the chat box really a great place to be. The thing that I wanted to point out on these silver metals was this hidden bullish divergence here that happened. Now then, since then, there's been lots of highs. This latest one is not actually divergent, but the fact that it's at a near 90 reading on the RSI on the 4-hour time frame does show that it's very much at that peak overbought sort of territory. Looking back to the last time you had peaks like this, it was at 3,500. Prices then dropped down to 3,122 afterwards. To say that this is overbought is just a classic kind of definition of what the numbers are showing you there. Not necessarily my interpretation of it. I do realize that this is kind of like a runaway train, but it does look very much like the parabolic thing that has a correction at some point. A correction down to 4,200, absolutely possible, would very much change the tenor of the chat in the markets widely if something like that happened, despite the fact that it'd only be back down to sort of the mid area of the highs back in October. So this type of thing would be more of a correction than a massive change in overall. I do think something like that can happen quite soon. I'm waiting to see if it happens. And one of the things I look into as well, of course, is silver. It's currently at 118, which is highs. Look at the 4-hour here. There's a little bit hidden bullish there. Now, I'm looking to see if there's highs that come in that don't have hidden bullish just before. So this is hidden bullish was back earlier on, quite a while ago. And then we go up to the moves through the next few days. I'm looking to see if there's highs that happen, such as the ones right now that haven't been preceded by hidden bullish divergence. If this were to turn around, then obviously that would be extreme bearish divergence, and you'd be looking at a breakdown in the structure. So while it continues on, and just to be clear, it's continuing on, so it's bullish, right? I'm looking to see if there's any sort of major threats that could result in pullbacks. This wedginess at the top isn't like the best, but what it actually does do is give it a breathing point before potentially going parabolic yet again. So looking to see if this falls around. I think that with the moves that we've seen, massive margin hikes in CME, COMEX, and in Shanghai is having an impact, but there's a lot of confusion out there right now around gold and silver. I mean, people think, for example, that the silver prices in China are, because they have VAT included on them on the Shanghai Futures Exchange and in the Western COMEX futures here, the silver chart, for example, doesn't include VAT, that if you were to minus VAT off of the Chinese price, then that would reconcile to this one. They think that that makes sense somehow, because you would think that if, like, you know, it was allowed to export silver from the Shanghai market to America, for example, stuff like that, or if there, or if you didn't have to pay the VAT if you're an American buying this stuff, you know, like stuff like that. If these things that you might take for granted were true, then that would be the case, but they're not. So there's confusion around, and that's where you get one of the most bearish things about silver and gold right now, which wasn't the case necessarily before, but is becoming one now, is that there's like a lot of Reddit hype about it. People saying things like there's not enough silver and stuff like that. Ridiculous stuff, which is similar to the chat that there was around GameStop when there genuinely wasn't enough GameStop shares to do the job, and it was actually happening. It's nothing like that in silver at all. Production, so, you know, there is a reducing in the demand from industrial people with regards to precious metals. Gold really doesn't have an awful lot of use. It really just is a safe haven type hedge. Silver actually has industrial implications. The industrial price of it should probably be closer to $60, you know, half of what it is currently. So we're in the throes of massive speculative hype. Has there been a diminishment in the demand from the industrials? Yes, there has. Waiting to see the commitment of traders report, which won't come out until next Tuesday, to get more information on that one. But I'm very much looking to see if the momentum here stops giving us hidden signals on this time frame for potential moves higher. The one that we've just had here is a result of the last one. So looking to see if we start to see a turnaround, or if we get more hidden bullish divergence. Drops below 57 on the RSI in this time frame would potentially indicate like a failure swing occurring, but it would also require structural movements, and you'd be looking at a test of $100. I think that there's the other things to note about this is, by the way, is that the open interest has continued to grow, hasn't been shrinking down. So there's something to be said about that. The fact that SPX went into all-time highs yesterday, as I was talking about this in the Discord, I did mention that it looked like during the run-up of silver, and I suppose gold, but actually just silver, up towards 117 here on Monday, that the drop down from 117 down to 101 afterwards was the start of that rotation, especially since the margin requirements went up around about midday. So when the prices around about, or American time, so when the price is around about $115 or so, they then secured what the margin requirements for the next day would be. Price dropped down to 101, but still those who were long would have needed to put up more margin, which could have increased, you know, to satisfy their trades, because the price was locked in at 115, but the ending prices were around 101, which could have led to the long squeeze towards the downside, as they just decided to sell off positions to cover the increased margin rate, and so on. They didn't actually get follow through on that, but when this does eventually turn around, that's going to be a part of the story. So I'll be looking out for that. Any more details that come out from from COMEX or Shanghai, which explain changes to margin requirements, very much to be looked into. But as you can see, the momentum on moves upward is diminished an awful lot. The market is being driven by speculators. It's clearly in a parabolic phase, and movements, if you want to use some objective measure, such as a Fibonacci from those lows, which were not even like markets, you know, overall market lows, just from $69 up to the highs here. If you see the prices closing below $107, you're down below the 236, and it starts to look like, you know, 101 and then potentially 80 for a test of these things if the market were to resolve. This is impacted so much by the geopolitical situation right now that, following up from the sign of the calm delivery of what was an obvious and very much telegrammed hold from the Fed, that you might get a sense of, I don't know, certainty from the Fed that might reduce the impact for the hedge. The debasement fears as well, the kind of the narrative was addressed by Jerome during that speech. He says that it's just not a thing, that it is on an unsustainable path, but the debt itself is not unsustainable. There's no actual debasement fear happening, really. So there's a lot of give and take. What we can know fundamentally, if we want to, with regards to silver, is that it's produced as a byproduct of copper. Mostly is there's very few silver mines. There's an awful lot of copper mines, and most of the silver you get comes from copper mines, not silver mines, which mostly happens in Mexico, which mostly ties back to the story that I had about a month ago or so. We're talking about Atlas Shrugged and how the Mexican in the book decided to stop producing silver in his mine or copper in his mine, and that led to a collapse in basically the world economy, which is maybe not one of the most talked about parts of the Atlas Shrugged book, but there you go. And the similar sort of thing happening now with various mines in Mexico and other places closing down, not actually having the copper they said they were going to have, not delivering. So there's been strain in the copper supply side. There's been change, despite the fact that there's high prices, which is a massive incentive, obviously, to get your mine working. So the incentive is there to increase the production of copper, which is the biggest thing, at least the byproduct of silver. The incentive is there, especially when it comes to silver prices as well. And there's a definite runaway kind of train aspect to it. The momentum is there for long in it if people want to do so, but it's definitely high risk overall with the potential for turnarounds. Is copper delivering to reduce that on the demand front? No, it's not, despite the fact the prices are high, but the incentive is there to increase the production. And the actual levels of volumes of silver that exist in the world are more enough to meet the demand needs. And many solar panels have changed to using copper, in fact, even though it's going to be less effective, just because the price of silver pushing their costs up from a few percent to 30% of the cost of the panel just isn't sustainable, and it's worth taking the efficiency hit and just using a cheaper metal. Problem with silver, of course, is that it oxidizes, so it needs to be used with other things or kept in a vacuum type environment. So copper is much easier to work with. Incentives like this, like we saw with lithium and the batteries, looking towards more sodium ash batteries and other alternatives, have been interesting of late. This is a weaponized part of the geopolitical struggles between China and America. Right now, restrictions on silver exports and so on from China actually make it so the American economy suffers as much as anything else. And by the way, when Trump talks about windmills and saying how China doesn't have any, it does have more windmills in the United States, but it's also got an awful lot more solar panels, makes all the solar panels, and it uses an awful lot of them too. So, and that's where a lot of the silver goes to, and other things. Like NVIDIA's costs go up an awful lot because the silver costs have gone up. That silver, when used in an NVIDIA chip, is consumed. It's not really recoverable, and that is a change in the dynamic. However, it's really only gone up. The demand for silver has only really gone up over the period of the last 5 years by something that some people account to be between 10 and 21%. Doesn't justify a over 300% rise in the price. So fundamentally, people are looking at it and thinking that there will be more to be said about this, that the debasement thing is more of a Reddit style. I don't know how much credence can really be put on that type of chat type of thing, and a lot of this liquidity at these highs does structural changes which change the requirement for margin, that does have implications for some rotation when somebody's looking for something to sell into. Whenever these longs close, they'll be looking to sell into activity and blow off tops whenever people FOMO in when it's late, or where that liquidity comes from. So is this a kind of bearish message? No, I'm saying that silver and gold and all the other, the gold is bullish. It's been bullish, been very bullish, but it's very likely to snap hard and fast when it does go to the downside, and that the implications from that could have various consequences for the rest of the economy, interesting ones. And it's interesting to see, while traditional markets achieve all-time highs, whether or not there's a rotation back into equities for greater thing. When I say that industrials are also, the demand from industrials on silver is actually not the driving factor here on the price, and it's to do with speculation, then you can understand that there's a massive risk on speculative play based on a risk off safe haven asset, which has got a narrative to do with how there's not enough silver in the world to satisfy the people who need it, even though there is. And then you start to think, at some point this house of cards is going to collapse, and that's what I'm waiting to see happen. But has it happened yet? No. And And it could it continue to rise up? Yes. And could it go on to 120, 30, 40, 50, $200? Yeah. One thing to note, JP Morgan, Citi, Barclays, a lot of other big banks at the start of the year said that predictions for things like S&P would be a high of 7,000 for the year 2026, and that the most egregiously, outlandishly bullish predictions for highs on silver in 2026 were around about the $120 to $150 mark on the most outlying top end ones, with most people predicting things like $60 and so on. So the fact that the prices are where they are now are beating all expectations for the year, and just in January, when it could be a blow off top, I think it's worth recommending to people to look out for when they stop seeing hidden bullish divergence on the RSI. There's your takeaway. There's your insight, your added value on the charts. My name's Rocky Outcrop. I love the fact that people have been talking away in the chat box here from start to finish. You've had Kitty's Never Die, who said hello first in the chat box. He's still here at the end. You've got JME, the trade spotter himself, in the chat, keeping everybody company and expanding on the things I've been saying, and many other friendly, wonderful people. A big shout out to the people who, of course, did my fan funding. Bring over these names here on the screen. Give a big shout out to Dashi C, Crazy, 1,000 Years of Darkness, Nick, Disco Biscuits, Dashi C, and Queen Jeannie and Bernard. Going to go and hit heart and read those messages now. Much appreciated. I'll see you all again next week. Like, subscribe, share with a friend.